for the most part of the last decade, Tata Steel has been all about its India business. That's the one segment where investors as well usually focus. But JP Morgan now is throwing the spotlight to the European business. They say that there is potential for substantial upgrades to the European steel business estimates. They believe that for the calendar year 2022, European steel prices should be higher versus their historical average, which is obviously then a positive read-through for Tata Steel Europe, leading to material upside risk as well to the business. They maintain an overweight stance on Tata Steel's share price with a target of 1,610 rupees. Now, first up, talking about European steel industry. They say that 2022 is now in play with strong end markets, low inventories and elevated utilizations. They forecast prices remaining at healthy levels for the next 12 months. In fact, they say that customers in Europe continue to sort of be living in hand to mouth. As an example, Germany's flat steel stocks are actually at an all-time low in terms of inventory. So there is going to be a release of demand that will come by, and they're assuming an average North European price for HRC at 700 euros per ton. Now, historically, Tata Steel Europe's EBITDA per ton has tracked MT Europe's margins, which, by the way, JP Morgan is forecasting will hit a level of $120 per ton. So for FY22 estimates for Tata Steel as well, they're estimating $120 per ton, but they see massive upside risk because the spot EBITDA per ton is already running at $150 per ton. The bigger issue though is FY23 estimates. Now they're expecting that the EBITDA per ton will moderate from $120 in FY22 to around $87 per ton. But if they build in the higher steel price assumption for FY23 as well, then the EBITDA per ton for that could go to $100 to $120 per ton for even fiscal year 2023, which in turn creates a 5 to 7% EPS upside and a 5% increase in FY23 fair value. So basically, if European steel prices continue to stay at these elevated levels, we will see obviously a sustained period of higher European business profitability, and this creates the possibility that finally investors will re-rate Tata Steel Europe's valuation multiple, which has, by the way, been a key drag for Tata Steel's overall financials as well. It was a huge drag during the steel down cycle of 2016 and 17, and even right now its margins are far underperforming the India business. So this is going to be an event to watch out for. Will the European business finally turn around and end up being a profitable one, a sustained profitable one for Tata Steel as a whole?